Okay, good evening, everyone. As it's already been stated, I'm Danielle Harrison. I am CEO of Business Navigators. Navigators is here to support business owners in more than just accounting and tax, but that's where we start. We believe that a lot of the problems or the issues or even the aspirations that you have as a business owner will sometimes originate from the finances, but they definitely do come back to the finances. Those things that happen in your books, they can either prove what you're doing or they can prove out what you're not doing. And so that's what we're here is to help support and to advise you on how to best navigate the struggles that you're going through from an accounting and tax point of view. I have been an accountant for, goodness, I got to count now. Over 15 years, been a business owner for about 5 or 6. So I think the important thing to understand, many people have worked with an accountant before. So usually when you're working with an accountant, you're working with another business owner. So just because this is what I do, this is also a business that I'm running. So I understand the struggle that you're going through, and that's I think what connects me with a lot of other business owners is that I don't just focus on well, make sure you got your debits and your credits right. Nobody else understands what a debit or credit is. Um, but I understand what the struggles that you're going through. I understand that you got to put your marketing hat on, and then you got to put your HR hat on and hire people, and then you got to put your IT hat on, and then you got to put the bookkeeping hat on. So I have to do the same thing. It's just that one of those hats fits me a little bit more comfortably than some of the others. So tonight we're here to talk about taxes. And the reason we're talking about taxes is because this is tax season. A lot of business owners, if you're just getting started in your business, like I think Shannon just mentioned, you're just getting your business registered with the state. Congratulations. Um, the income that you begin bringing in this year will be part of what you need to report for your taxes for for next year. So understanding what to expect when you have to report those things, that's what I'm here to share with you. Um, so first thing I wanted to let everybody know is something that just kind of came out, was announced today, is the BOI, which is Beneficial Owners Information Report Filing. So this is something that's been on and off and on and off again. And so now it's back on. And for those business owners that if you're registered with the state, that means you got an LLC or you've registered as a corporation, this is going to affect you. It is not a huge undertaking, but there is reporting that you need to do. It should just be one time that you have to report. The only time you need to do an update is if there is a change in your ownership status or maybe your business moves. So I wanted to real quick, I'm going to drop the filing website in the chat so that you have that information. The beneficial owner information is going to be due by March 21st of this year. Originally, it was due by last year, right before January 1st. And there was there was a court case and all this hoopla. I'm not going to bore you with all the details, but as to whether or not it was constitutional. But the purpose of this reporting is basically the government wanting to crack down on entities that are possibly funneling basically supporting terrorist activity or just like businesses that shouldn't be there. Like you can have a lot of LLCs around the country, and they're not really anybody from the US that's supporting those or holding up those LLCs. So the information they're asking for is kind of similar to what you do when you file for your LLC when you're registering with the state. It's just that when you register with the state, that information stays with the state. So this is at the government level, basically, is what's going on here. So let me get this link for you. And feel free to grab that. Let's see here. Okay, there we go. That is an online link. If you go there and kind of go back, if you want to pull a paper application, you can do that. But please do make sure that you fill that out. You may see ads from companies that provide this service for you. You're welcome to do that, but you do not have to. Going to this website is free. So I think that this is important to state because especially when you're just starting or your business is not as advanced as you'd like it to be, making sure you're investing your dollars where you have to invest your dollars is important. So this is something that doesn't take a long time, maybe like 20 minutes or less, but you can fill that out on your own. If you feel like it's just too overwhelming for you, yes, you can consult with someone and pay them to do it. Just beware you don't have to. Next, let's talk about taxes. So for most of you, if you are registered with the state or you're not registered with the state, your tax return is going to be due when your normal tax return is due in April. So what I mean by that is if you're an LLC and you're the only owner of your business, you are considered a sole proprietor. That's how the government looks at you. And so your sole proprietor is going to be listed on a form called a Schedule C. And that form is going to be part of your 1040 filing. So you don't have a different due date for your tax return. It's going to be part of what you report um, in April, which the deadline is April 17th. So I'll put that in the chat as well so everybody's aware of that. Now, if you are a business that is registered, you registered with the IRS to be taxed as what's called an S corporation or a C corporation. The S corporation and the partnerships are going to be due by March 17th. Actually, I think that was April 15th is what the due date for the tax return is. So I apologize for that. The reason why those dates might change, the 15th is usually the tax deadline, but the reason why those dates might change is if that date falls on the weekend, then it's going to be the next business day typically. So that's why I have it in my head or I have it somewhere, but sometimes I get those dates confused. So I want to bring up about S Corps and let you know that. So a lot of times you'll hear a lot of information on TikTok, marketing and everywhere, and everybody's like, become an S Corp, become an S Corp. It has a lot of great benefits, and I'll get into those a little bit later. But I do want you to understand that it is not necessary to become an S corporation to get your business started. Just getting up and getting started, trying to generate sales, bringing the income in, that's the most important thing when you're starting your business. Getting with a tax accountant to help you understand what's going to be best as far as taxes are concerned, and not just taxes, but helping you to build and establish wealth. That's what you want to look at as your business grows. But an S corp is only relevant for taxes. It doesn't mean anything at a entity registration level. And so what I mean by entity registration level is when you register as like an LLC, that's only recognized by the states. That is legal protection. And I can't talk to all things legal that we need to bring in an attorney to kind of delve into those things. But an LLC only protects your assets for your business from your personal assets. It doesn't do anything as far as taxes are concerned. Your taxes, the government is going to say, okay, if you are a single owner, then they're going to treat you, like I said, as a sole proprietor. If you're an LLC and you have more than one owner, that's going to be considered a partnership. And so there's a specific form that's used for partnership. So you might have you and your spouse or you and your significant other might be partners on paper for your business. And if that is the case, then when you registered with the state and then got your EIN with the government probably sent you a form saying, hey, because you have more than one owner, we're expecting you to fill out a partnership return. You can then elect to be treated as a corporation and elect either S status or C Corp status. So those are your corporations, and that's when you get into additional tax benefits, which like I said, I can, if you want to know about the differences there, we can delve into that. I don't know, I don't want to bore anybody, and I don't want to go too deep in the weeds if you're not ready to go there. But those are the things that you want to know about as far as the tax deadlines and what form you should expect to file with your taxes. I'm going to pause real quick and see if there's any questions over anything that I've said so far.
Yes, I have a question.
Okay.
Um, so if you have an LLC,
Mhm.
are you not considered a sole proprietor?
You are.
Okay, okay.
Mhm.
So an LLC can be a sole proprietor, one owner, right?
Yes.
Okay, okay. When you said
Mhm.
LLC and like partnership, I got slightly confused.
So an LLC again is your entity that you're registered at the state. Now the
Right.
ownership that sits under that LLC, it could be one owner, and in that case, from a tax point of view, you'd be considered the LLC is considered a sole proprietor.
Okay.
Okay. Now,
Uh-huh.
if you're an LLC and you have more than one owner, then you are considered what's called a partnership from a tax perspective.
Okay. Gotcha. Thank you.
Mhm.
Danielle, what happens if you don't file your taxes?
Mm.
Um, if you don't file your taxes, um, they're not going to come for you immediately. We do not want to make a habit of this, but there are penalties that get become assessed when you file your taxes late. So, and if it continues to recur, that can become a issue as well. So, if you continue not to file your taxes, not to report your income, one thing you should understand is that if you, especially as a business owner, a lot of times you may be doing business with other businesses. And a lot of times, what they're going to do is they're going to send you what's called a 1099 form because you're operating as like an independent contractor. And so in January, you probably saw it was getting an influx of 1099 forms where those businesses that you did provide a service, like Keontae, you provide, you do event uh, things, right? So if you're doing events for Core, for other businesses, and they paid you more than $600, they should have sent you a 1099 form to report the income that they've paid to you. That form that they sent to you, this also been sent to the government. So the government is getting different types of forms, and they're seeing the income, at least some of the income, maybe not all of it, but they're seeing that there's some income that's being reported to you. And if they don't see your tax return coming in to support what they're already receiving, that's what can cause issues. It's the same thing with like a W-2. You get your W-2, the government, the IRS is going to get your W-2. Um, interest forms, 1099 interest, 1099 Rs for investments and things like that. All of those get copied to the IRS essentially. So when you don't file your return, what they can do is they can take that information that they have received, and after so long, they will create a return for you. And sometimes that's not going to be good because that return is only going to show income. It's not going to show anything to reduce that. And that's where you can get in a lot of trouble. Plus, it's been filed late. So you're going to have all the penalties and interest that get built on that. So this session, I said I wanted to reduce anxiety through awareness. So I don't want you to be afraid of, oh my God, I've got so much I've got to pay for taxes. That's a normal course of business. That's part of business. Is so you're going to have to pay taxes. We don't want to pay more than we have to. Um, and we don't want to evade taxes either. So if you get it down to zero, that's fine, so long as it's legitimate. But don't bite your nose to spite your face, I guess is the saying as it goes. A lot of the things that you'll hear brought by CORE, all these different initiatives and things like that, going even back to COVID, a lot of the funding that was available to business owners was available because if you had bookkeeping and you had maybe your taxes and you could show that you had income coming in. But if you always show that you have zero net profit, then that doesn't show anybody else that you are a profitable business. And then, especially with these federal or state funding, they're like, well, we can't loan this, we can't provide this funding to you because your business is not really doing anything on paper. So, those are the things that you have to kind of balance as being a business owner from a tax perspective is that you don't want to pay more than you have to, but reporting zero is not always the best. It's not always in your best interest either. So, Janelle, you have a question.
Yes, can you hear me?
It's a little low.
Sorry. Can you hear me better?
Yes.
Sorry about that. You talked about a S and a C corp status for partnership, but have you ever seen that in a sole proprietorship before?
Yes. So a sole proprietor, Usually you need to be at least an LLC. But yes, you can elect to be taxed as a S corporation and be a single owner. You can elect to be taxed as a C corporation and be a single owner.
Okay. I wanted to ask the next follow-up question only because I was doing a little research.
Okay.
Is the reason why people can elect to do a S or a C corp because of an instance for maybe an issue with LLC such as double taxation, and they might want to go over to a S or C corp because of something like that? And if so, could you explain a little more simply?
So the double taxation thing that a lot of times you'll hear about happens with the C corp. The reason why it's said that it's double taxation is because you have the money that you've brought into the business, that you've brought in through operations, sales of your products or your services, minus the expenses, whether those are expenses directly related to what you're selling or expenses related to running the business. Once you subtract those things, you have what's called net income. That net income for a C corporation gets taxed because a C corporation is like a separate person that the government recognizes and says, well, just like this individual needs to pay taxes, this business entity needs to pay taxes. No other business structure has to pay taxes on the federal level other than a C corp. And so that net income that you have left gets taxed at the C corp level. And then whoever is the owner or the CEO of that C corp, if you take distributions from the C corporation, that's going to be money that you pull out for personal uses, essentially. Those distributions get taxed as well. So they've already been taxed at the business level, and then they're going to get taxed when they come to you as income. So that's what that double taxation means. But your other entities, the way the tax works there is they're called pass-through entities. So a S corp, a partnership, you may have the same result where there's going to be net income at the end of the year. That net income doesn't get taxed at the business level. What's going to happen is that money is going to flow through to you as an owner, and that's going to be part of what gets reported. Just like if you were working a W-2, you'd have a W-2 that you'd report what an employer paid you. For your S corps and your partnerships, you as an owner in that business, you'll get what's called a K-1 form. And that K-1 is going to report what the business paid you, and that'll be what you report on your individual tax return. So that's that money that passes through to you. Yes, Kyle.
Okay, can I ask one more
Oh, go
follow-up
ahead.
question?
Go ahead.
Oh my goodness, what was the question? I think I forgot. If I remember it, I'll raise my hand again. I'm so sorry. Oh,
Okay, Earth.
could this be possible with an independent contractor situation?
So an independent contractor, that is a status. Usually an independent contractor may not have any designation, and it's another term for you might be a sole proprietor, basically. If you haven't registered with the state, registered your business with the state, you're you're an independent contractor. If you have, you've registered probably as an LLC. The tax designations, the other tax designations that you have available to you, you usually would have worked with an accountant to get those set up. So that's probably not an issue for you if you haven't registered or anything like that, and you're just an independent contractor.
Okay, thank you
Everything
so
that you make is going to pass through to you on your individual return.
Okay, so how I'm hearing it is independent contracting is okay, even as an S corp. And thank you for helping to explain double taxation.
Okay. Go ahead, Kyle.
Danielle, does it ever make sense for a sole proprietor to register as a C corp?
Um, unless when you start your business and you already have maybe investors on the line and you want to make sure you have as much as many options as far as investments coming into your business. So, Kyle, you being in the tech industry, when you get started, yes, it might make sense to start off as a C corp. If you're still kind of at the idea stage, it might be, you might have a proof of concept, but you haven't really got to that level where you're ready to start like kind of pitching it to everybody. It doesn't make sense to get bogged down in all that administration right off the bat. Um, if there's significant liability associated with your business, sometimes it does make sense to at least register as an LLC. Because again, whatever you're doing for your business, you want to protect it. So like say, Susan, you have the horses, especially if there's people coming out there, you most likely are an LLC, I would assume. Because there's some liability there. And again, liability has to do with asset protection, legality, not taxes. But as far as becoming a C corporation, it may not, there may not be a need to do that from the get-go. Any other questions? Janelle?
What is ideal about the C Corp? I guess as I'm hearing it, it's like they taxing at a federal level and all this administration. What's usually, what do you find were people who benefit from a C Corp structure?
So even though there's taxes to pay, for one, right now, corp level, your taxes that you pay at that level are actually less than sometimes the income that, or the tax bracket that you might be at the individual level. So that might be an appeal. A lot of times the C Corp is really more about the structure and the flexibility that you have with that structure as far as the growth of the business and what you have available. So again, for a lot of businesses where you're looking to have other people investing in the business, other entities potentially, you have a lot more flexibility in who you can go after and who can become who can invest in that business than you can with any other. I mean, people can give you money, yes, but they can't really invest in the business and get a return on it like they can with the C Corp. There's also other benefits for with the structure that you have. Like if you have employees under a C Corp, there's a lot of different benefits, retirement options that are available that you can take advantage of. So those are some of the benefits there. Yes, you do have the double taxation. You're usually working with a tax accountant to help kind of minimize that. By the time those dividends get to you, again, you're not being taxed on the same level of income. It's a little less. It's just that because you're the owner of the business as well, you've already experienced that maybe 21% bracket tax on at the business level, and then whatever your personal bracket is, you got to take that on that on what you've received as dividends. Does that answer your question, Janelle?
Yes, thank you so much.
For most of us, it doesn't make sense right now, to be completely honest. So for some of us, the S Corp doesn't make sense. Like I said, a lot of times if you're on TikTok, you'll hear everybody say, as soon as you start your business, get an S Corp. But again, those things, it's not just about the tax benefits that are associated with that, but there's also there's an administrative burden that you have to take into consideration. And sometimes when you're just getting started and you're wearing all the hats and you have to have all of this administration and paperwork that you have to abide by in order to keep that S Corp intact, it doesn't balance out to the potential tax savings that you have. And so it's best to wait until usually you have a reasonable amount of profit that you're recognizing your business kind of consistently. So maybe after 1 or 2 years of say around 50 to 60,000 of net profit, then it makes sense to consider looking at changing the entity structure. So you can start saving on taxes and capitalize on some of those benefits that come from that tax status.
I have a question really quick.
Okay.
So I was looking like with our documents and everything, and
Mhm.
we technically last year in the US only had business done in December. So will
Okay.
we just file the taxes for just the 1 month?
So taxes are, you're reporting the taxes for what happened in the year. So whether you were in business in the entire year or just the last quarter or just 1 month, that's what you're reporting. Now, as far as, I don't know what your entity structure is. Is it You're on mute.
Sorry. It's LLC.
Okay. And are you the only owner of the LLC?
Yeah.
Okay. So if I remember correctly, it's like 400. If your business made more profit than $400, even though it was just 1 month, you could have done that. Then the IRS is expecting you to report that on your Schedule C.
Okay, cool. All right, thank you.
Mhm. So that brings up another question. How do I know what type of entity I have? Again, if you've registered with the state, then typically you do have an entity that you've set up. It's an LLC. You could have registered as a partnership if you have more than one owner. The other thing is you've probably went to the IRS website and you've applied for what's called an EIN, which stands for Entity Identification Number. When you apply on the IRS website, it'll also generate a letter saying that we've received your information. And depending on what you put on that application, it will let you know what it's expecting, what type of tax return it's expecting you to file. That form letter, I don't remember the letter numbers, but there is a form, it's called a SS4. If you haven't gotten an EIN, when you do that, so Shannon, you've registered with the state. Your next level is to get your EIN if you haven't done that yet. When you do that and you see that letter get generated, make sure you print that off and keep that with your records. You can print it to PDF, you can print it off on paper, but just make sure you save that document, okay?
I'm looking
That
for it
doc
right now. I have it though. I was looking to see
Okay.
if it said the SS. Yeah.
4 is what it should say in the corner of the file. And like I said, there is also like a letter number, but I don't remember all that in my head. So I will let you all in on a little secret. I'm an accountant. I do taxes. I do people's books. I don't calculate things in my head. I don't trust my head anymore. So don't ask me to figure a list of numbers and expect it to be right. I'm going to put it on a spreadsheet, my handy dandy spreadsheet, and I'm going to figure that out for you. So, but yes, you want to make sure you keep your document that you have from the state. You want to make sure you keep your SS4. Make sure those are your business documents that should stay with you um, for the extent of your business. And then that will determine what type of tax return you should file. Anybody else have any questions? Go ahead, Meg.
I'm sorry if this has already been answered, because I came in late. My kids are real. And
That's okay. Mine are too.
but my question was on things, if you do business in multiple states and then you are filing business taxes with on a state level with both states, can you write off those taxes on your personal taxes, or yeah, I guess that's my question. Yeah. Can I tax write the money that I paid to taxes off of my personal, or is that just money that I straight give on a state level and never see it again?
So let me ask first, are we talking about things like sales tax in multiple states? Or are
Yeah.
we talking about registering to do business in those states?
Both,
Okay.
because, like, for example, let's say I do Kansas City Farmers Market that's in KC and then I also do Lawrence Farmers Market, and I'm paying taxes on both Kansas and Missouri. Um, from my understanding, and I just found this out, that I have to register in Missouri if I'm selling stuff in Missouri on my sales tax. But do I report to a federal level that I am taxing sales in both states?
On a federal level, no. So you have your sales, and regardless of where those sales occur, all of that will be totaled up. The sales tax is actually not part of your sales. Sales tax, no matter what state you're in, is what's called a pass-through tax. You're really just kind of collecting that money on behalf of the state. So rather than the state going and collecting that themselves, they're asking the business owner, you're selling this product, you collect this sales tax from the end user and you send it to the state. So really, if you think about it, that's money that's coming in and it's going right out. So there's no impact to you unless you're not structuring your sales tax correctly. And if you all could give me just a moment, I'm going to finish answering this question, but my children are yelling at the door and I don't want them to hurt each other.
I appreciate you answering the question.
I'll be right
And
back.
take your time. Kids are real.
How's she make it look so easy? Just talking about like accountant stuff and like mom, and she's just so graceful. Are you guys
Okay,
finding? Oh, go ahead.
oh, sorry. I was going to add in there about the sales tax really quick, because I do that with my balance business. So if you look at the amount that the sales tax is, like say for your county, Megan, if you tax your customers enough, you'll just pay like the state of Kansas what you collected. I can help you out with that too. That's all I had to say, Mom.
I guess my question on that is, do those I'm only thinking because I know that like Kansas state taxes, the tax rate changes per year. I'm assuming. So is that posted somewhere that I can look at what each state's tax rate is to find that information out before I go to that place and do business? Or is that something that I need to go to a state level thing to find out?
It should be on the state's website, like so the state of Kansas, it'll tell you like what the sales tax is, and it usually, I believe it goes by the county that you live in or the county that you did your business in. Um, I don't know the site off of the top of my head. Are you registered as a like for sales tax to pay sales tax?
I am in Kansas and I just
Okay.
did it from Missouri, like literally last week, although I've been doing business in Missouri this whole time. But I thought that I tell the state of Kansas that I did business in Missouri and that I'm pay, that they split that somehow. I don't know in my head. And I found out that I have to stay licensed, registered with both states and pay taxes individually, which is why I asked, now that I have both of them, do I need to report on a federal level somewhere that I'm reporting taxes in both states?
So yeah, let me finish answering that question. At the federal level, no. So all of the sales that you make, which was what I started saying, combined together at the federal level. The federal level doesn't care that you did business in California or that you did business in Kansas or Missouri. Missouri and Kansas care, and so they're going to want a piece of the pie. But the federal government is just going to look and say, if you made a total of $50,000 in sales across the United States, then and there's no other expenses. I'm just keeping this real simple. Say it's $50,000 is what you got as, then that's what you're going to report for businesses, for business purposes. Now at the state level, because you have to report sales tax in Missouri, Missouri is going to request that you register to be a business in Missouri. And so because of that, that's where they're going to want you to report the income that you made in Missouri. And the same thing for Kansas. They want to know what portion of your income is from Kansas, what portion of your income is from Missouri. And then because like Missouri has, say like if you're in Kansas City or something like that, they might have some taxes that are there. When you pay taxes, even if those taxes are still going to flow through to you on your individual tax return. And what you pay in taxes, I'm not talking about sales tax. I'm talking about if you pay tax on your income for those businesses, that is not deductible as a business deduction on the individual level. There's typically not a lot of tax. There may be like a registration fee, not a registration, but what's it called? There may be like a franchise tax fee or something like that. I'm thinking of like, I have some clients that are in California And just to have an LLC, there is a tax, there's kind of basically this flat tax that you pay. And then so much profit, they have different brackets and there's so much tax that you pay at that state level. So does that answer your question, Meg?
Yes, and thank you.
Okay. And do you understand about the sales tax? Because I want to make sure people understand that sales tax is not part of your income. It's not part of your total sales. It should never. And it really, people get in trouble with sales tax. So like if you sell something for $10 and you have $2 of sales tax on top of that, you should take that $2 and put it in something separate because that's not part of your sales. That $2 belongs to the state. The $10 is your sales. That's what you're going to report. Beth, I think you've had your hand up for a while.
My question is, so if you get a grant, is that taxable? Is that income?
Potentially, yes. And I'm glad you brought that up because that was on my list to talk about as well. A lot of times we have grants. It potential. So when we were back in COVID days, there was a lot of funds that came out at that time, and a lot of times those grants were not taxable. But at the state level, sometimes they were. And so grants can be taxable. It could be considered income. Again, if you got expenses to offset that, then it may not be. So like say if you get a $5,000 grant, but if you've got $3,000 of expenses to go against that grant, then you're not reporting taxes on 5,000, you're reporting taxes on $2,000 of income. I think I said $3, 3,000 expenses.
If I have cost sharing, so I have a one-to-one cost sharing on a grant, does that kind of, and I spend everything accordingly, does that kind of negate?
So explain to me cost sharing.
Well,
What
cost
do you
sharing
mean by
is
that?
where we're gonna give you $500, but you have to put up $500 of your own money.
Oh, so not exactly. So when you put $500 into it, that's more of you contributing into your business. If they're talking about you need to spend $500 and then they're going to give you $500, that's more of them reimbursing you for what you spent. So then yes, that negates it because the income that they give you against the expenses that you did, it's zero effect, $0 effect. I'm not sure who was first, Raina and then Brianna.
Hello, sorry that I'm so late. My question is, when I do sales, instead of taking the time to figure out the tax at the time of sales, I decided to take it out of like the total price. So like, let's say I sell a book for $10. And then when on the back side, what I do, and I just want to make sure that I'm doing this correctly, is I take my total sales and I figure out what the tax amount is going to be by multiplying it by the tax rate. And then I subtract that tax amount from the total sales. And then that gives me my actual sales and the amount of tax. Is that correct?
So what you want to do is you want to take the tax rate and you divide it by, like you take 1 plus the tax rate and divide your sales by that number. And that gives you your tax portion, your sales tax portion and your sales. If you're doing something on the website, you want to check and make sure that for some states, and I have to go back and research for Kansas, you need to state basically that basically your sales tax is inclusive of the sale. You can't just publicize it. Like if you publicize that you're selling it for $10 and you don't notify the public that the $10 includes sales tax, then the government or the state government basically says, well, your sales are $10. We're expecting sales tax on top of that. Does that make
I do.
sense?
I do
Okay,
publicize when
great.
yeah.
Okay, great.
Okay.
So yes, that's fine. What you're
Okay.
doing is correct.
Okay. Thank you.
Go ahead, Brianna. No, Brianna and Catherine are my sisters.
You actually started to answer part of my question, but I was talking about I was wondering, selling products online, do you have to file sales tax in other states because or just only because they're purchasing it from you and you're shipping it out of your state? Does it only apply to that?
So that gets a little bit complicated.
Okay.
Sales tax, unfortunately, from state to state does not look the same. And every state, including Kansas, as um, not wealthy as the state is, it tends to make things very complicated. You would think that, hey, you need to encourage more revenue. Let's not make it so complicated to get the revenue, but that's not the case. So with sales tax, with other states, what you'll have to check and see is it's a term called nexus. And so basically, other states will have thresholds when they're going to require you to report sales tax. Once you meet that threshold, and there's different considerations. So for some states, they might say, well, if you've got, say, 200 transactions, or you've made at least $100,000 in sales, then we're going to require you to start remitting sales tax. And again, you'd have to see what those restrictions are, what those regulations are for each state. For some of them, if you have a business presence in that state, you might have what's called physical nexus. So if you've got salespeople distributing things in that state, or you're constantly going there to deliver your products or something like that, like in the case of maybe Missouri, um, that could trigger nexus, which means they're going to be expecting you to pay sales tax or report sales tax. So it is possible, but not necessarily right off the bat. And then also you can check with, like, if you have say a Shopify or something like that, an e-commerce website that you're selling through, you can check and see a lot of times they might handle the sales tax for you, or they can handle the sales tax for you. So it makes it real easy. So those are some of the things that you want to check into. Did that answer your question?
Yes, it did. Sorry, I thought my mic was off. For those apps that there is one connected to my website that kind of helps navigate the different state sales tax. But it does have me go in and enter it in myself. So I find myself like having to search that up. Is that the best way to approach that, or is there an actual form or website that
There's
would,
no website that's going to do everything for you. You have to
okay,
go to every state's website. But
okay.
there are some applications that will kind of automate the sales tax or help you to understand, like it'll provide research. So there's a application called Tax Jar. I'll put that in the chat. And then there's also one called Avalara. And so these are sales tax applications. They can plug into your accounting software. A lot of times they can plug into, again, like if you're using kind of like an eBay or a Shopify or some of these e-commerce website, they can plug in on the back end so that as your sales are coming through, they are capturing that for you, and they can help you to basically it'll send you alerts to say, hey, you're getting to that threshold where you're probably going to need to register with this state. It can help you register with those states for to remit sales tax. They can help you report sales tax to the different states as well and get those paid for you. They don't pay it, they take it out of your account and pay it for you, just so you're aware.
Thank you.
You're welcome. Shannon.
She kind of had the same question as me. I just want to make sure I'm not missing anything with it. Um, yeah, I just see this website. It's like called bigcommerce.com. It just explains how to stay sales tax compliant. And it does say like the software doesn't file and remit your taxes for you. You still must register your business with the local tax authority. I think that's just where I just don't want to get lost or get in trouble somewhere, is making sure I'm filing the taxes correctly in different states.
So there's again, like I said, with some of the different things that you have to do in your business, especially if you have products that you're selling, there's going to be an administrative side that has to be maintained. That has nothing to do with maintaining like your business entity like we talked about before, but in order to be able to sell products in different places, everybody wants a piece of the pie, essentially. But usually to register first, that you can either do yourself, just like you have to go to the state of Kansas, the Secretary of State, and register your business there. In other states, you're going to do what's called a foreign qualify because this is your home state, usually in Kansas. If this is where you live, this is where your business is. You can also register your business, say like you've heard of people registering Delaware or Wyoming or, different places like that. So that might be your home registration. And then everywhere else, you'd foreign qualify into the state of Kansas. So that's usually the first step. You can, again, do that yourself. There are applications, there are different services that can do that for you. You just tell them what states you need to be registered in, what type of taxes you need to register in so they can register your business in those states. They can register, get you registered for sales tax. If you're going to have employees in different states, they can register you to be able to report employee payroll taxes in different states as well. Did I answer your question for you, or did you have anything else, Shannon?
Is this just something that I should do along, like, so once I get my website up and going, and once I see what states I'm selling in, do I then go and register in those states?
I would say wait until you're getting, if you see you're getting sales in other states, be aware of how much are you generating those in those states first. Um, I'd say probably once you reach like say 5, 10,000, then start doing some investigation into, okay, what's their requirements? Because so long as you're not there, like you're just shipping things to that state, that's one thing versus like say again, if you're doing pop-up markets in different places, you have a physical presence in that state now if you're going to be doing that. So just beware of things like that. If you already know that you have a lot of opportunity in different states, then yes, do it now. But if it's still like really ambiguous for you, stick with your home state, get that right first, and then as things develop in other states, then start looking and see what you have to do there. It's kind of basically the same thing in every place. It's just, they have a little spin on how they want you to comply with them.
Okay.
Let me see here. Make sure I don't have any questions in the comments. Okay. Shannon, this is what I hear. Complete LLC registration or S Corp through the, so S Corp is not through the state of Kansas. S Corp is at the federal level, just to make sure that we're clear there. What you're registering at the state level is usually LLC. Corporations would register at the state level because those can be an entity and it can be a tax designation. So the reason why it would be just a tax designation and not at the entity level is if you're already an LLC. So that's your legal protection. The difference there is like a lot of times people will be an LLC because there's a little bit less administrative burden for an LLC. And there's less restriction there's more restriction as to who can invest in your LLC. Like they can only be US citizens that can invest in the LLC. The C Corp, which Janella, this is another benefit of that, is if you're going to have foreign investors potentially, then that's where you want to look at the C Corporation. But with that LLC, you could elect to be an S Corp. And that just means I get the benefits of a corporation. I can avoid the double taxation of the C Corp with an S Corp, but I can still I don't have all of the administrative burden associated with being a full corporation.
Something that just dawned on me, Danielle. This is really in the weeds, but most things accounting are kind of in the weeds. So, yeah, with the C Corp, you definitely have the double taxation, but also if you're taking distributions or guaranteed payments or whatever as a member in your own LLC, aren't you also effectively taxed at a higher rate than if you would be an employee of another company? Like, let's say if you made $20,000 at company X versus $20,000 from your company, the amount of taxes that you withhold are actually higher because the employer, if you are not working for yourself, is actually withholding some for their portion of FICA or whatever. Whereas if you're working for yourself, you're kind of withholding, I guess ultimately you're spending more on taxes. Is that correct? Do I have that right?
Here, let me break this out for you. So this is something I do for clients when we start talking about what's the difference. What does that look like? So the attractiveness of the S Corp is the fact that you now become an employee of your business. An S Corp and a C Corp, you're an employee of the business. You might be doing the same thing that you were doing before, but when you're considered a sole prop or a single member LLC, what you do in your business, the work, all the hard work that you're doing is not classified as an expense. So you can take draws out, which you should be. The way you pay yourself is you just take money out of the business. If you're an LLC, you just take the money out. Don't run your business where you have, like, say, if you got to go to the grocery store because it's time to fix dinner for the children. Yes, the children are real, but with your LLC, don't go pay for the groceries on the business account. If you're going to pay yourself $100, take the $100 out of your bank account and then go spend the money however you want to. You can go put it in your personal account, but that's how you should keep that straight. Okay. When you are an employee of your business, any employees, whether it's you or other people that you've hired, those employees that what you spend on those employees is a business expense. So that's one of the benefits and one of the, like I said, attractiveness of an S Corp. And I'm just going to do an S Corp right now. Because like I said, there's some other things that go along with the C Corp. These are usually at our level of business, with the exception of probably Kyle, because you're probably a C Corp, aren't you?
No, because we haven't started taking money from institutional investors yet. So institutional investors are not going to write you a check until you're a C Corp. But a lot
Right.
of like angel investors actually prefer the tax benefit of you being an LLC because your losses can then basically reduce their tax liability.
Mhm. Okay, so with the sole prop single member LLC, let me see if I can get this. Let's say you have 100,000 in total sales. This is just, again, I've sold my product, I've sold my service, I've gotten a total of $100,000 from my clients and customers. And then let's say in order to generate that level of income, I needed to spend $50,000 in expenses. Okay. On what we call a profit and loss statement or income statement, what you have left is $50,000 of net income. This $50,000 in net income does not equal what you have in your bank account. We would all love it to be that case, but that's not what happens. Out of this $50,000 of net income, you've also maybe taken out $25,000 to pay yourself. That $25,000 that you've paid yourself over the course of the year is not part of these expenses up here. That's what happens on what we call a balance sheet. And I can do another workshop when we get into the details of like financial statements, which is very important. Okay, hold on. What's everybody doing here? Meg, what are you
Sorry,
doing to
I
me, honey?
accidentally marked a couple things and then I erased them. I don't want any
Let me see.
options to do that.
I don't know how to. There we go. Let me see if I can move this over. Okay, there we go. So we got $50,000 in net income. When we just took looking at this from a tax perspective, that's all the state is going to look at, and that's all the IRS is going to look at is you got $50,000 in net income. It doesn't matter that you don't have $50,000 in the bank. This is what you've reported, and this is, like I was saying, if this is what the reality is, we don't need to zero this out unnecessarily just because you don't want to pay taxes on this. But we do need a plan for it. Now, what happens with this 50,000 is you are not paying taxes on the 50,000. That's going to flow through to your personal return. Your personal return is where we're going to see you will have your standard deduction, or maybe you itemize. You might have the qualified business income deduction on your tax return. If you have children, you might have dependent care tax, credits and things like that. So before your tax gets calculated at the individual level, there's other deductions which are going to reduce this income, and there are other credits that could reduce the tax that you have to pay. The thing that can't be reduced once we report that you have $50,000 is what's called the self-employment tax. And this is what knocks entrepreneurs in the face because we're not prepared for that. Okay. So self-employment tax is, I'm assuming that everybody here has worked a W-2 job before at some point in their life, or you've related to somebody that you've seen them get a W-2 or they get a paycheck. When you get a paycheck, the company that you work for, they take out the taxes from your paycheck and you get net take-home pay. What you don't see is that company is also paying the other half of those taxes for you. So part of it comes out of your check, the other half comes out of the business. And that is the payroll tax that gets reported to the state and to the government. When you are a sole proprietor, a single member LLC, both sides of that come from you. So this $50,000 of net income will be taxed at like 15.3%, which represents both the employer side and the employee side of that tax. Okay. 15.3% of 50,000 can be quite a bit. On the S Corp side, remember how I said maybe you took out $25,000 to pay yourself as a sole proprietor? On the S Corp side, we could have the same situation, excuse me, where we start off with $100,000 in sales. We have $50,000 in expenses. And let's say we also have, you're the only employee, so we're going to say $25,000 in payroll. The payroll is an expense, but I'm just calling that out so you can see the difference here. So now your net income is not $50,000. Your net income is $25,000. The way you get taxed as an S Corp on the $25,000 is you have already paid your payroll taxes associated with this $25,000 of payroll. And that's wrapped up in these expenses. I didn't do all the calculations and stuff like that, but we're just trying to keep the math simple. You've already paid your payroll taxes, so you won't have to pay any more payroll taxes on that. The $25,000 is what flows through to your individual tax return. And your individual tax return is where that income can get adjusted down. So let's say that's all the income you have. Let's say you're married. Your standard deduction, if you're married, is going to wipe out that $25,000 because it's, I can't remember the number off the top of my head, but the standard deduction is going to basically net that to zero. You can't pay taxes on zero income. Okay. So that's the difference is that the S Corp, just on a tax basis, that's the allure of becoming an S Corp, is that if you have a lot of self-employment tax that you're having to pay because you're reporting a lot of income, then that S Corp is very attractive because you only pay basically the payroll tax on what you have as payroll and it's expense to the business. And then you may not have any other income that you have to do at the individual level, depending on what your deductions and credits look like. You're welcome, Sherelle. Let me put my contact information here real quick. I'm going to put my scheduling link here if anybody wants to schedule a call with me. There's no obligation, but if you've got other questions or something that's specific to your business, you're welcome to book a call with me. Whether you want to work with me or not, at least you'll know what to ask your tax preparer. I'm a big proponent of not being afraid to ask the people that are supposed to be helping you in your business. And so if you feel like I don't know, then talk to me and I can help you form the questions that you need to ask the people that are in your corner. Did I answer your question, Kyle?
Yes, definitely. That's interesting. I never knew very much about S corps, so
Mhm,
it makes sense then why like maybe attorneys' offices would go that route instead of the LLC route.
mhm. And like I said, the LLC, you can be an S corp. That's just the tax. That's the way you're going to be taxed. But you can still be an LLC.
Yeah, right.
Yeah.
Thanks. Appreciate that.
And is that something that you can change mid-business, or once you commit to it, it's it?
That is a great question. So that is also one of the benefits of at least getting your LLC in place. Because let's say this is your first year in business and it's February, it's early, you're in an LLC, and we get to the say Q4 of this year, which is going to be like October, November, December, and you've already made, say, $250,000 in sales. You've got a lot of income that you've made. We can make an election, a late election, to have you treated as an S corp. And we can take that late election, go all the way back to when you formed your LLC, because you haven't formed it, you haven't submitted any tax returns. So let's say the 2024 tax returns are due. I actually have a client where this happened. She's been an LLC for years, but she made she her sales were over $1 million. And so she's going to have a lot of net income for 2024. And so because she hasn't filed a tax return for 2024, we went back and we elected to have her treated as an S corp effective January 1, 2024. So that way we can go through and we can treat the entire year, and she can capture this benefit here on this side as S corp for the entire year, and then every year going forward. The S corp, once you elect it, you can elect out of it, but once you elect out of it, you can't go back into it for 5 years. So that's one of the things that you want to be aware of. And that's one of the reasons why I don't advise business owners to just jump into an S corp, because if you're not making enough money, at a certain level, if you're not making enough net profit, there is no difference between what you have to pay in taxes as an S corp versus as a sole prop or a single member LLC without that tax designation. So then all you're left with is all the compliance that you have to maintain to be an S corp, which is not necessary. But once you cancel out of the S corp, you can't go back into it for 5 years. So in 5 years, yes, you could be there, you could be ready to transfer, but you'll have to wait until that window is closed. Yes, Janelle.
Sorry about that.
That's okay.
Do you recommend a yearly filing or a quarterly filing?
So your tax returns are filed yearly. Now, if you have taxes to pay, if this is your first year filing taxes, the IRS is not expecting you to pay anything in until you report that you have tax liability that's owed. Once they see that you owe taxes, like say if this is for 2024, this is your first year where you're going to owe taxes, then they're going to expect you to pay quarterly taxes for the next year. But for this first year, they're not going to expect that. So what you're doing on a more frequent basis is you're paying quarterly taxes, you're paying estimated taxes in throughout the year. But when you're actually reporting your return, that only happens once a year, in March for S corps and partnerships, and in April for all other entities. Does that make sense?
Yes, thank you. The other thing I wanted to ask about is you were talking about the nexus. What were you saying, there was a distinction between a type of a nexus? Because I heard you say physical. So is there like an electronic or a physical? Is that how I'm hearing it?
Essentially, the physical nexus just means that there's something that's creating a physical presence in another another taxing authority, usually a state. So again, like if you have, for some companies, they may have employees that are working in different places. They may have sales reps that are, physically in different states. They may physically themselves be going into those states, like I said in the example of a lot of people here are doing pop-up um, vending events. And so when you're selling in other states, that creates physical nexus. The other type of nexus is basically where you have a lot of transactions that are occurring, and it's just transactions. So either it's a dollar, that regular nexus is going to be based on a dollar threshold or a number of transactions threshold. So again, if you have like 200 transactions, then they might trigger, say, well, you need to register so you can report sales tax, or it might be 200 transactions and $200,000 of sales, or it might be or $200,000 of sales. Those are the things that trigger Nexus, but you haven't physically stepped into the state yet. But because you have so much activity going on, they're like, hey, it's time for you to pay us too.
Thank you.
Mhm. So I'm not going to talk a lot about financial statements, but I do want to share really quickly about some things that are really important to get prepared for reporting your business income. So it's really important that all income that came into your business should be reported. Not just like if you got 1099s, like I said, those get reported to the IRS as well. But sometimes maybe people are paying you in cash. That is supposed to be reported. So just so you know. Your expenses, it's important that you're tracking your expenses as well. It's important that you're tracking your expenses over and above just, well, I have a bank account and that's what, where those expenses, I have those all listed there. It's important that, either if, even though I love spreadsheets, they can become kind of volatile after a while. It's easy to delete numbers, fat finger numbers and things like that. And so that's where I prefer some type of software. It doesn't have to be super expensive and it doesn't have to be super complicated. But an accounting software is helpful for tracking your income and your expenses for your business. It is tracking your business and expenses is more than just following your bank statement. It's about categorizing what type of activity you're doing. So you have different money that you're spending for maybe website hosting. Maybe you have Facebook posts that you're boosting. Maybe you have other social media sites that you're at or other different type of marketing activities. But all of those things represent marketing expenses. So you need to capture all of that as marketing expenses. And then you might have other things like you've got accounting fees. You might have, again, if you've got employees, maybe payroll tax, capturing all those things together, because from a business standpoint, one, you can see what your business is doing over time and make better decisions about that. So if you see like your marketing dollars are steadily going up, but like your sales after a while are not trending up as well, they're not going to trend one for one, but you should see your income increasing somewhere behind the investment that you're making in marketing. That can be triggers for you to say, hey, I need to go look at my marketing, not necessarily reduce what you're spending, but maybe you need to change where those dollars are at so you can get a better return on where your marketing dollars are going. There might be some expenses where it's like, I'm paying for these things because sometimes we have that fear of missing out. And so it's like every shiny object that comes up that's for the business, we want to sign up for all the apps, but all the apps don't really help your business. And so sometimes it's good to cut those things out. Sometimes when you're paying attention to your sales, you may have pop-up events are great, but maybe there's one particular area where you do a lot better than others. So a sale is not always a sale. Like every dollar is not always a good dollar. Maybe if you have like consulting, if you have a consulting services, what it costs you to service one client may not be worth it as far as what they're paying, the energy that they're sucking from you in order to deliver the service to them. It may not be worth it. And so you might want to change the type of client or customer that you're targeting because they don't bring you joy, they don't bring you money, so on and so forth. So those are some of the other things that we can get into on another date as far as is your business healthy? From a tax point of view, when you wait too long to track your sales and your expenses, sometimes you run the risk of missing things. And so just like we have this example in front of us where it's $100,000 in sales and 50,000 of expenses, if you haven't tracked properly, that $50,000 could easily be like, well, I only see $25,000 expenses because I haven't been paying attention. And then now you're paying on $75,000 in net income when you did not have to. So that's one of the big important things about bookkeeping and tracking your expenses and making sure that whatever is legitimately a business expense, you should be able to capture that. So that way you're not having to pay as much in taxes. Does that make sense to everybody? Yes, Janelle. You have some great questions, by the way.
Thank you. Can you hear me?
Yes.
Okay. The other question I wanted to ask is, okay, I got the whole S corp thing, and that when I was talking about double taxation, that was what I meant about the self-employment tax for the LLC, but maybe I was saying the wrong thing when I said double taxation.
Gotcha.
Now on
So
the
yeah,
S corp, go ahead. What were you
go
going
ahead.
to say?
No, I was going to say that that's not double taxation. That's
Okay.
just the fact that because you're not an employer, you're not considered an employer. Uh, for you over here, if you're S corp and you're the only employee, then yes, you're still paying both sides, but you're only paying both sides on what you've called payroll. You're not paying both sides on the total 50,000 like we were over here on the left. Does that make sense?
I think when I kind of talk with you more, when you had said book the appointment, I'll probably get it then. But I'm
Sounds
glad
good.
that you helped me because I didn't know what it was called. I just looked at it as double taxation because it just kind of looked like that to me. But thank you. You said it's called payroll is what it's called? Or what is it called when
It's
they're
so what it is, it's called self-employment tax.
okay. Okay. Okay,
The
got it. I
reason
do
why you
have
have double taxation is because with the C Corp, let's just use this $25,000 here. Let's say this was a C Corp. This $25,000 would get taxed in the corporation. And then let's say that $25,000 gets distributed to the owner as well. That $25,000 has already been taxed in the C corporation. The business itself has already paid the tax on that. Once it gets distributed to you, the owner of that C corp, you're going to pay tax on that $25,000 at your tax rate. That's what double taxation is.
yeah, no, I understand what you mean by that now. Okay.
Yes.
Okay, so I'm gonna move on to my next question that I was gonna originally ask you. Okay.
Okay.
So about the X Corp, I got everything with the comparison to the self-employment tax for the LLC versus the payroll and the expenses and the individual return of the payroll on my tax. But what happens with all of that you said about the S Corp, all of that, and then you have somebody taking funds and reinvesting them back into the business?
So you have your salary and you're saying you take that and you put it back into the business instead of taking it for yourself?
Um, just putting it out there loosely that when I looked at it, this was where I was splitting hairs about which entity is what, because I didn't understand where was best, if anything, versus whatever you're filing is being reinvested back into your business, because I thought that that's what made the distinction between LLC, S Corp, and C Corp too, is if you're reinvesting back into your business with any of the dividends.
So let's, in either of these cases, once we get down here to what your net income is, once we arrive at what that number is, whether you take that money out of the business or not, you're still going to have to pay the self-employment tax over here on the sole prop and single member side. Whether you take this $50,000 out or not, you can leave it there and not pay yourself at all because you're going to use that money, next year or something like that. You're still going to have to pay the self-employment tax on this. So I am a big proponent of paying yourself. You may not pay yourself necessarily what you're worth just yet, but you should get in the habit of paying yourself. You're gonna have to be taxed on that anyway. You might as well get something out of it. You've been putting all of this effort, sweat equity, whatever the case may be, into your business. You need to get something out of it. Otherwise, you're gonna run yourself into the ground early, and we don't need to do that. When you reinvest into your business, that looks different. That's not considered sales or income. That's going to show up on a different place for your financial statements. And that's kind of a larger conversation about what that means. But there's no problem with doing that. That once you reinvest that money back into your business, that doesn't create any additional taxes. So like if you take this $50,000 here and you put it back into the business, it's not going to turn into sales. There may be expenses that come out of it, so that could reduce whatever the current sales are for that next period, because you're using that cash for some purpose in the business. Does that make sense?
Yes.
Okay. But it's not going to trigger any future taxes on that, what you reinvest.
Okay. But what my question is, so my let me look at what I'm looking at. So whether it be my registration or my election as an entity or what have not, it doesn't make a difference if I'm reinvesting it back in my business, whether I do it under LLC, C Corp, or S Corp. That doesn't make a difference. I hope I'm
Correct.
asking the right question.
Yes, so that's not going to trigger anything as far as taxes are concerned.
Okay. So how I register my legal entity from LLC, S Corp to C Corp with all of this, and I reinvest it, there's nothing to consider there. Thank you.
It's not going to, from a tax perspective, it's not going to reduce or increase your taxes.
Okay, so what that sounds like to me is it gives me a little bit more freedom, because that's where I was hung up on. I was understanding certain things about double taxation, but like what you said, the reinvestment is another conversation. So that was where I was held up, because I'm like, well, what do I do then? So that's kind of where I am. So thank you.
Okay.
So that's a conversation between me and my business advisor, in other words. So thank you.
Correct. Kathy and then Shannon.
So what if you don't pay yourself at all? So I have a business account that I put everything into, and I will use I put everything back into my business. So if a customer pays me, that money that they pay me, I use to build my inventory, or I buy supplies for charcuterie or something like that. I have not actually paid myself. I don't use that money for myself at all.
So then, for one, from this, if we're looking at sales and expenses, if I'm assuming that there's something left over out of your expenses, you're not spending all of the sales down, but you are leaving basically cash in the business so that you can buy more inventory. When you buy inventory, that is what's called an asset, and it doesn't become an expense to your business until you sell it. So you got funds that are getting tied up and being held on your balance sheet. Again, that's a larger conversation. We get into financial statements, but that inventory is going to sit over there until you are ready to sell it. Once you sell it, then that's when you have your sales that gets recorded and your expenses. And then we arrive at net income, but that's how that works. But paying yourself over on this side as a sole prop or a single member that hasn't elected any type of tax entity. Oops, sorry. Here we go. Paying yourself or not paying yourself, that doesn't change anything. So again, if you have total sales of 100,000, you have $50,000 of expenses, Out of this $50,000 of income in your example, you would have taken, maybe you took all 50,000 of that and you bought inventory. So here, according to the IRS, they still see $50,000 of income because that inventory that you use the cash on, they don't see that. That's not part of the tax calculation, basically. Does that make sense?
Yes.
Now, once you sell that $50,000 of inventory, then we kind of come through and do this again. You'll have 50,000, you'll have sales. Let's say you're selling it for it's cost $1, but you sell it for $2. So again, you have $1,000 in sales, you have the $50,000 expenses. Again, you're going to have $50,000 in net income. That passes through to you personally. You get taxed on that, however that shakes out on your individual return, because everybody's individual situation is a little different. So that's why I say that could be different. The one thing that's going to be the same for everybody is that self-employment tax. So the self-employment tax will get charged on this $50,000. Okay. So again, I don't recommend that you don't pay yourself. Maybe you can't pay yourself $50,000, but you should pay yourself something.
I just didn't know, like, I did it out of fear, basically. Like, I just didn't want to risk messing anything up, basically. So everything that gets put into that account stays in that account.
Let me ask you a
But I
question though.
completely
Did you start
understand.
your business to be scared? And did you start your business not to get paid?
I started my business because I thoroughly enjoy planning parties, but I don't know. This is why I joined this meeting, so that I can't be scared anymore. Give me the tools that I need to actually make things shake, if that makes sense.
Yes, and that's great that you enjoy what you're doing. But we also need to have a serious conversation with yourself or with somebody else, whether it's with Core or whether it's another business advisor, as to whether or not you have a hobby or you're trying to build a business. So if you're trying to build a business, then yes, you need to consider paying yourself something, taking something out of the business so that, because um, as much as you love doing parties, there's a lot of effort that goes into that. And there's a lot of work that you have to put in. Like you have to buy everything, you have to go set up everything. And yes, you love the experience and you love the results that you get from once you've done a party, but is there anything else that you want for what you've done? Because I mean, what happens when you're doing like 15, 20 parties? Is it just for the experience at that point? Is that what you're trying to get to? So those are like some of the larger conversations that you want to think about is like, okay, I'm assuming you have something else that you're doing on it, like maybe a full-time job or something in addition to this, or is this everything?
I have 2 jobs on top of this.
Okay. So as much as you love doing what you're doing with the parties, do you want to continue? Do you want to grow that passion? And if you want to grow that passion, you can't hang on to both of those jobs and grow that passion. Something's going to give, and I don't want it to be you.
Amen. I got you.
Okay. Shannon, what's your question? I think, Kiati, you and I have an appointment early in March too, I think. Okay.
Sorry, I couldn't find my mute button.
That's okay.
But okay, so like when it comes to taxes, like this is one of my biggest questions is like I'm saving all my receipts right now. Like what do I need to save? Like I know I can save every receipt, but like what am I going to need when it comes to tax time out of those
So
receipts?
tax time, the receipts are proof in case of an audit. You don't
Okay.
have to save the physical receipt. You just need to save that documentation. So one of the things that I recommend is we have our smartphones, take pictures of those so that way you can
Okay.
save them as a PDF document. That's the simplest and least expensive way to do it. If you want to get really sophisticated, there's apps I can recommend that you can use where it'll, especially if you're using an accounting system, there's apps that you can take pictures of your receipts. It'll connect it to your accounting software and push it there so that once the transaction comes in from your bank account, it can attach that receipt with the bank
Oh,
transaction,
that's
and that
awesome.
way, yeah. So there's a lot of
I
slick ways that you can set it up.
I do accounting for a living, but not your kind of accounting. Like I do it with KU and KU Med.
Uh-huh.
So yeah, we don't have all that.
Yeah.
Uh,
So I mean, at the end of the day, accounting is accounting. A debit is a debit, and a credit is a credit. But there's government accountings,
yeah,
university, things like that is a little bit different. There's some nuances there, even for like a nonprofit, and some different ways
um,
to present the information.
like whenever we file our taxes, like you hear of people saying, "Oh, I was able to deduct that," like or deduct
Mhm.
that. Like, what is that? Like, I don't know.
That
Like,
is these business expenses here. So
okay.
everything that you spend money on, like for accounts, as she was talking about inventory, that's not a deductible expense. It becomes deductible once you sell the inventory, but
Mhm.
just holding inventory is not. If you have to purchase equipment, so like say you're a graphic designer and you got maybe equipment that you've purchased, that equipment that you purchase is an asset. Let's say you drop $5,000 on a really fancy piece of equipment. The $5,000 that you spent is not a business expense in and of itself. There are some special depreciation. You might hear those terms used around. There's some
Mhm.
special depreciation terms that can be applied that allow you to be able to take basically deduct the $5,000. But
From
normally
your
what you have to
income, then
do
is that
from
what
the
that means?
sales, from your
Okay.
sales is what that does. So instead of,
Okay.
let's say you had some assets that you purchased this year. In addition, and we were able to take 100% of those assets and depreciate them this year, then we could lower this from like say $50,000 to maybe it's 55,000. Or excuse me, 45,000. Got to go the other way
Okay.
because of those assets. But those are, again, conversations that you should have. That's why I
Yeah.
say sometimes you don't want to zero out your income because in the case of equipment, that sounds great. But let's say you're not planning on buying it and making any more investments in equipment for the next year. What you could have done is you could have maybe taken an accelerated depreciation, not all of it. So that way you have some more expense that you can take later on in the future years for the life, for whatever that useful life of that equipment is. So those are
Okay.
the conversations you need to weigh. Do I just take it all now because I don't want to pay more taxes today? But then I might be in this situation next year, but I don't have any equipment that I've purchased. And so I'm going to be in this situation next year. What do I want to do here? Do I want to kind of split the difference?
Okay.
Kyle and Janelle. Oh, excuse me. Jennifer had a question. Jennifer in the you didn't put it in the comments. Did you want to come on
I
off the
just had a
grid?
question. I just had a question about expenses and inventory.
Mhm.
Um, Normally, like in my primary business, I clean, so everything I buy, I use up within the year.
Mhm.
But I bought a bunch of things to tie dye, but I only sold a small amount. So are all those expenses not, can I not take them all when I actually purchase them? I have to wait until I sell that said item?
For the tie dye.
Yeah.
So that's kind of a different business model from your, you have a cleaning business, I'm assuming. Is that what?
Yeah, yeah, that's what I've had for a while. So like I've done
Okay.
taxes for it before and I
Hmm.
can tell what my expenses are. But for this, I've spent a lot of money, but I've only made a small amount of sales. So
Right.
do,
So
but
if you're
if I
building
purchase tied
inventory,
items, yeah, I just
yeah,
always thought you had to use it when, or like you take the deduction when you actually purchase it.
in some cases you can do that. But in most cases for things like that, where you're building inventory, that inventory is not considered a business expense until again, now there may be some aspects of that. So like if there are things, small things that you're having to buy, but like by and large, like say if you're buying a bunch of t-shirts that you're going to tie, those t-shirts are typically going to be inventory because you're going to be selling each t-shirt. Then there's other things that you need to do to those t-shirts. So maybe instead of buying all your supplies, maybe you just get the t-shirts, and then as you get orders, you get like the paints and things like that that you need to get that at that time. That way you kind of conserve your cash flow along the way. So get what you need to get. So maybe if you get the t-shirts, it's better to buy those in bulk. Okay, typically you get those at a good
Well, but
price.
what I'm doing is upcycling. So like I'm always
Okay.
sourcing. but it's like I'm not keeping track of like this shirt I paid $2 for because they're not all the same price. So it's hard
Right.
to know what I've sold and what I still have.
So yeah, those are some things we'll probably want to get into, have a individual conversation about that and see what we can do in those cases. But generally speaking,
Okay.
if it's inventory that you're buying, then yes, no, inventory is not going to be an expense until you can sell it.
Okay.
Okay,
Okay.
Kyle. Oh, I'm sorry. Did you have another question? Okay, go ahead, Kyle.
Just super quickly, I guess, receipts. I don't keep them.
Mhm.
And I'm now talking about core. Like, let's say we have a $2 expense here or there. Like, I'm not sending that to John. I could just be parking so that Monique and I can go meet each other at the office, aka in a coffee shop. Um, like, do I really need to keep like find a
Everything.
receipt, send it to John? Like, what's John gonna do with it?
So, even the IRS has kind of a threshold that they say if it's like $75 or more, that's what they've kind of set as arbitrary. The other thing, because CORE is a nonprofit that you want to consider, is if there are grants where there's reporting that has to happen and you're claiming these expenses that are in the organization against those grants, or maybe you need to get reimbursed, then it kind of essentially doesn't matter how big or how small. It just depends on, like, maybe parking is not something that can be reimbursed or not. It's not covered by a grant. If there's no reporting requirement, if this is just maybe purely operational on the operational side, then for a nonprofit again, you can set some thresholds for yourself, which is really important to do. Set some financial policies and procedures, how we're going to treat things, what's going to be deductible. But it is good practice to get in a habit. Like I said, there are some apps that you can use. It's real quick. As soon as you get a receipt, snap the picture, and that way you're not constantly sending him paper receipts and everything like that. He can go in maybe once a month and go through and make sure he's got everything documented. If you've got an accounting software, which I know I've talked to you guys a little bit about, again, it can send it right there to the accounting software. So you've got it captured with the transaction. But it's not saying that you have to capture the $2 receipt. I have some organizations, some other nonprofits, where they kind of set that threshold too. It's like, this is parking. No one cares about that unless it's like $500 of parking. Then we've got a question.
Right. You
Um,
can credit card receipts just suffice? Like, look, here's our credit card statement. It's got all the things on it.
it's going to be the same thing as a bank statement. So no, that just a credit card. If you ever look at a
Or I mean,
statement,
bank statement.
yeah,
I
a
mean,
bank or
really.
credit card statement doesn't show, it's not the proof that of what the transaction was, what the purpose of the transaction.
My
So
husband's behind
sometimes,
me and he's like, no, because he just knows from me and my work. He's like, no.
yes, no, the
That's
He's like,
physical
no,
enough.
jump in there.
receipt, that's what the proof is. So that's what happens. So accounting is really about tracking what happened in reality and translating that into dollars. It's telling a story. It's not just numbers like you see this 150 and 25. Those are numbers on the page, but that tells a story about your business. And when you look at that over time, it also tells a story about what your business has been doing over time. And so the bank statement, sometimes you might see, like, say, if you buy things off of Amazon, you could have bought a printer off Amazon or you could have bought printer paper off of Amazon. All it shows in the bank statement is Amazon transaction. Now, you might remember that, hey, the $500 was the printer I bought off of there and the $5 was printer paper. But again, according to the bank statement, it doesn't say anything. So you need to have the receipts. You need to have the Amazon transaction, printed to PDF, have your receipts sent to your email so you have them captured there or something like that. There's ways to make this easy and not such a chore from an administrative standpoint.
Thanks.
Chantel, then Shannon, then Janelle. And then I've got a little bit of time, but I know it's 8 o'clock. So
I do want to say,
Mine-
after these quick questions, we do have one resource that will Kyle will share that will help you access Danielle's services as well. And then we'll say goodbye.
Mine will be really quick. It's going back to the BOI, Fallon. So if I took a workshop at the end of last year, but I failed mine in January because they were saying like go ahead and file it just in case. So I don't need to file again in March.
You do not. This is only
Okay.
for those businesses that have not filed yet, because like I haven't filed mine. I was just like, well, if it's not required, that's just me. You didn't hear this from me. That's just me. I
Thank
was
you.
like, if I don't have to, I'm gonna wait till they make a decision. Now they have, so I will make sure I get mine filed by the 21st of March. But if you've already done it, you don't need, if there's nothing changed since then, you don't need to make any updates either.
Okay.
Shannon, then Janelle. And then I think Raina's got her question as well. I don't know where we probably have to cut off after Raina. And we'll come back
I
to,
think my
oh, there we
hand
go.
was still up, like from last time. So
Oh, okay.
I don't have a question.
Janelle.
To just follow back up, to be a registered LLC, but to elect to file as an S corp, can that be permanent, or do you have to eventually go to an S corp?
No, you don't have to, you don't ever have to select to be an S corp. Whether it makes sense or not, you could be making $1 million in net income, and if you don't want to be an S corp, you don't have to. I mean, you should have enough money to pay whatever those taxes are, even though there's going to be way too much in taxes. But if you don't want to, you don't have to.
Okay, thank you.
Raina?
Thank you. So, really quick, I bought an iPad to do digital drawing for my coloring books, but I got it secondhand used. If I were to have gotten like a person to write a receipt for it, would that count?
As a documentation for it? Yes.
Okay. Thank you.
You are welcome.
Danielle, thank you so much for gracefully getting us through that and taking the anxiety out of it. Appreciate that so much.
That's good. I hope everyone is like,
If you want to add your connection, how to connect you, just so it's at the bottom again, Kyle, and if you just want to wrap it up real quick and talk about the link you just added to the chat, please.
Yeah, absolutely. If everybody wants to just kind of copy and paste that out of the chat, that little blurb there, that can provide more context and we can send that out to everybody. But basically, if you need help from Danielle, this is a way to potentially pay for that. So you go to that link and then fill out that form. And so these technical assistant grants are offered via the Kansas Department of Commerce, and they're administered by this other entity called Network Kansas. So seems like we ought to all take advantage of that and use those dollars to pay Danielle or whomever else, you know, you may need that kind of fits into those buckets. But it seems like everybody probably needs some accounting help at this time of year. So this might be a good use of that grant.
yes. And once you start doing it, don't just wait until tax time. Tracking
You
your
don't want us to
business.
like throw everything at you like on April 1st or
No,
14th.
I will I will happily put you on extension if you do that, just so you're
Right.
aware.
Right.
But no, I mean, you're doing your business a disservice. Whatever you're looking to achieve, just waiting until the last minute to do those things, you're not helping yourself. As taxes aside, you need to be paying attention to what's going to the health of your business. So that's the larger benefit of bookkeeping and accounting and looking at your financial statements in your business.
Right on. Well, thanks again, guys. Please follow our Facebook page. We're trying to resuscitate our socials, share our flyers, and keep showing up. We deeply appreciate you, and we'll get this recording out in email as well. Thank you guys so much for being here tonight.
Thanks, everybody.